Hey guys, what's up? So today we are studying income statement. Income statements show how much a business generated during a specific period and the amount of expenses incurred while earning that revenue. Whatever you are making and whatever profit you are getting, you will see that in income statement. Income statement is also called profit and loss statement. Here is the format of income statement. First thing you do is you write sales. Whatever sales you made throughout the period, for example, over here it's for year ending December 31, 2012. Till December 31, whatever sales you made are written over here. Alright, for this year, for this period. Okay, so 50. Then you are going to subtract your cost of goods sold. Now sometimes cost of goods sold is already written. Okay, so they will just tell you that cost of goods sold is this. However, that's not the case every time. Sometimes you have to write it. For example, over here there are three things given: material, labor, overhead. You added all three things and you got cost of goods sold, which is 25, and then you subtracted this from sales. Alright, so you got gross margin. Do you remember the previous video we made when we talked about gross margin or gross profit, net income, net profit? If you don't, I will link it in the description box. Do check it. Alright, then there is operating expenses. So whatever expenses that incurred while you were operating in this year will be written over here. Again, it could also happen that people might just give you operating expenses without giving you anything else, and you have to just write that term. Or it would be divided in a number of expenses and you have to write them and then add them and then subtract them from gross margin or gross profit. Then it will be your operating income. And then what you will do is you will write any other income or revenue and expenses in this column. Revenue obviously will be added and expenses are your expenses, right? You paid money for it. So you are going to subtract that amount from operating income. Over here it's written interest, revenue, interest expense, extraordinary items. And after subtracting this, we got income before tax, or you can also say profit before tax. And then we subtracted our tax from it. Now after subtracting the taxes, we got income. Now after subtracting the taxes, we got net income. And that's our format of income statement. A few things you have to remember: sales minus cost of goods sold minus operating expenses plus other revenues or income minus other expenses. Alright, that will give you income before tax, and then you will deduct the taxes from your income, and that gives you net income. Alright, so this is your income statement. Now exercise time. Alright, so now it's time for an exercise. Yay! Alright, I do want to say the gross margin, cost of goods sold, gross profit video is very important and you must watch it. It will be linked in the description box, because during exercise I will be talking about those and you might be like, I don't get it, you know. So do check that video. Now trial balance. Over here, first you have to see what are the accounts that you will take to your income statement. Mostly it will be revenue or expenses. Sales, revenue, yes. Purchases, expense, yes. Rent, expense, yes. Lighting expense, general expense. Fixtures and fittings. Okay, you might be thinking fixture and fittings should be added, and I understand your point. It's perfectly fine, you are doing really well, but fixtures and fittings won't be added because they are your asset. They are accounts of balance sheet. Why so? See, fixtures and fittings, you are not going to utilize it just in 1 year. It's gonna stay with you for a longer period of time, and you cannot put it all in one income statement. That would not give a true picture of your revenue. So what are you going to do? You are going to put this in your balance sheet, and you might be deducting depreciation amount, which we will add in our income statement as well. Depreciation is basically, alright, so let's say you got a laptop for 15,000 and you were like, oh my god, this is gonna stay with me for at least 3 years. Perfect. So now what are you going to do? This is your asset. You will think that yes, every time I use this laptop, this is going to decrease its value. Obviously, it's going to be a used machine. And so, keeping that in mind, you are going to divide your whole amount for every year. It's 15,000, so you are like, in every year, this laptop loses its value, that is 5,000 rupees. Alright, it's losing its value. First year you consumed it and you are like, I have consumed 5,000 value of this laptop. 10,000 is remaining. Then next year you consumed it and you thought, okay, 5,000 more. You have equally divided it. Okay, there are other ways and we will talk about depreciation in future as well. But this is just to give you a rough idea that what happens when you buy a big asset or something that's gonna remain with you for a longer period of time and it is not included in your expenses, operating expenses. And then next, creditors, bank cash are not your sales or expenses. They are just telling you what business have right now. So most of these will go towards our balance sheet. Alright, so you have decided, okay, highlight or just tick the things that you know should be added in your income statement, so that when you are, going through it, you can easily work on it. You know exactly what I have to add. So do this step first. Then there is some extra information, and that is of ending inventory, your closing stock, which is 3,000. We have to make an income statement, obviously. Why do we need ending inventory? We need it to determine the cost of goods sold. If you are confused about it, video is given in the description box. Do check it. So first thing that comes is sales. Alright, there is sales. Then next thing is less cost of goods sold. You are subtracting cost of goods sold. First of all, what you will do is you will subtract purchases. Then you will subtract closing stock. Closing stock is what you already have. Closing stock are the things that you were not able to sell to the customers. So sales minus cost of goods sold, what is it? It's gross profit or gross margin. Alright, now you are going to subtract expenses from it. Rent, lighting expenses, general expenses. Alright, you wrote them, you added them, which became 4,500, and then you subtracted it from gross profit and you got 8,000 net profit. If there was any other revenue or other expenses that we didn't know where we should write, we would have written it over here before net profit, and we were not given any percentage for taxes. But if you are given a percentage for taxes, then you have to add that. You have to mention it, okay? So what will you do? Net profit, and you will get that percentage out of net profit arrives. That's your net income. Alright, so what will you do? You will take net profit and take the amount. Let's say if it's 10%, you will see what's the 10% of 8,000. That's your tax amount. Then you will write taxes minus the amount of taxes paid or you will be paying, and once you minus that amount from 8,000, you will get net income. Alright, so this is your income statement. I would tell you, please do check the previous videos. It has almost everything and it will help you a lot in understanding this video as well. I know my voice isn't the best voice right now and I'm having some issues with my voice, as you can see. But yeah, I really wanted to make this video. I hope you guys enjoyed it. If you did, make sure to give this video a thumbs up. Do subscribe and share, and I will see you guys in my next video. Bye guys.